My name is Monty Leffoltz from Omaha, Nebraska. I have a two-part question. What is Berkshire's philosophy on paying dividends, and under what circumstances would Berkshire pay a dividend in the future?
Well, that's a good question. We paid a dividend in what, 1969, Charlie, at 10 cents a share. I can't remember it, but it's in the records. We would be very likely to pay either very large dividends or none at all, because our test is whether we think we can use money at a rate in a way that it creates more than $1 of market value for every dollar we retain. Obviously, if we can keep $1 and it becomes, on a present value basis, worth more than $1, it's foolish to pay it out. Forget all about taxes. Assume it's a tax-free society. We would have exactly the same dividend policy up to this point, whether there was any tax on dividends, capital gains, or anything else, or whether we were entirely tax-free, because we have retained money, because to date we have felt that if we keep $1 and use it in buying other businesses or whatever it may be, that it becomes worth more than $1 on a present value basis. I mean, not that it's going to be worth $1.10 4 years from now, but it's worth more than $1 when we look at what it'll be 4 years from now. That's subjective, but any given decision like that is subjective. Over time, you get an objective test as whether that's met by whether we do indeed create more value than each dollar of retained earnings. We create an extra dollar plus of value. If that changed, and it could change, then we would give the money to the shareholders, and it might be done through repurchases or it might be done through dividends. But there's no reason to keep $1 in the business that's worth 90 cents if you keep it in the business. And there are companies that do that, but they're not necessarily intentionally doing it. They may have higher aspirations as they go along, but they're not realized. We, I think, would be fairly objective about trying to figure out whether we are indeed creating value or destroying value by retaining earnings. We would never have a conventional dividend policy. I mean, the idea of paying out 20% of your earnings or 10% or 30% of earnings in dividends strikes us as nuts. I mean, you may get yourself in a position where you have to do it because you build these expectations in people's minds, but there is no logic to it whatsoever. The logic is basic. If you create more than $1 of value for $1 retained, why in the world would you pay it out? Because the people who want to get that $1 as a dividend can instead get $1.10 by selling the stock for, or whatever it may be, $1.20 for the value that was maintained and or retained. So that it's a very simple dividend philosophy, and one I think that's in one of the past annual reports. We explain the logic of it, and I see nothing that would change in terms of the principles of it. Evaluating whether that's the case. I mean, obviously we aren't going to make a decision every week based on whether we can employ money that week at a higher rate of return or every month. But in terms of a reasonable expectancy over a couple-year period, whether we think we can use retained earnings advantageously, that's our yardstick. Charlie?
Yeah, what's interesting about what Warren is saying about logical dividend policy is that if you went to all the leading business schools of the United States, all the leading economics departments, all the professors of corporate finance, this wouldn't be the way they teach the subject. In other words, we're basically saying we're right and all the rest of academia is wrong.
We love it when we do that.